Thomas, do you have clients that specifically trade SPY QQQ with Married Puts so they have reasonable success being constantly hedged? Yes, Thomas, I have a fine mix. We have a fine mix here at Power Options of blueprint owners I talk to on a consistent basis. I have blueprint owners that have SPY QQQ and even TQQQ as Married Puts in their portfolio, have for years. Consistently, what they're doing is having a Married Put on SPY or QQQ where the put is almost 2 years out in time. When it gets to 6 months, 5 months, or 4 months to expiration, wherever the stock is, up or down, they just roll that put out going forward. They collect the dividends, and then they make adjustments as well. Do they have reasonable success? These are people that have been with Power Options and radioactive trading for at least, the ones I can think of, the half dozen I can think of off the top of my head, at least 6 to 7 years, maybe more. They're still doing it. So even if they're not beating in their mind the buy and hold of SPY, which, by the way, we showed last week in that video, low maintenance trading or their fire and forget trades. Ernie's beaten buy and hold of SPY, for the past few years, several years, with the Married Put approach, following the rules in the blueprint and following the default screens. Now, William, those investors that I have, not William, Thomas, those investors we have that are doing that, they're also doing the other securities. I can think of maybe only 1 or 2 people I've talked to in the past 2 years that are older blueprint owners that just have 1,000, 2,000 shares of SPY or QQQ and just trading as a Married Put. And that's, 80% of their portfolio. And then the other 20%, they're buying some calls here and there, doing some fund spreads, doing some poor man's covered calls. That's it. That's essentially where Ernie is, but Ernie's using the stocks. It's preferable to have the stocks that match our criteria, that have a little bit more volatility, to get better results from the income methods, management techniques, and bulletproof faster. There's nothing wrong with doing those lower volatility SPY, QQQ, Married Puts long term. And again, the half dozen or so I can think of, I can talk to, of the hundreds or thousands of blueprint owners that we have. But I talk to on a regular basis, at least once a month, is where I'm going, Thomas. That's only one of them is that the main portion of their portfolio. 1 or 2 of them I can think of. Or Ernie has a regular coaching session with a gentleman where he pointed him to just using, he's almost 86, 87 years old. And Ernie just pointed him to using most of his portfolio for just SPY, Married Puts, and making the adjustments. And Ernie walks them through it, and they touch together. He has a coaching session with Ernie every week, essentially. Every other week, but it's every week, I think, the past few weeks. He's got some other positions open too. But Thomas, you can do that, but your expectation of return is going to be lower. Okay. Last year at SPY, when we ran the screens last week of the year-to-date return for SPY, it was up about 22.4%. Now, of course, that's from about January 2nd, 2024 to where we were on January 3rd, 2025. But during that time, just the top 8 default Married Puts that matched the criteria at the beginning of the year were up 35.7%. That's pretty much where Ernie's portfolio was with the Married Puts in 2024. Mine lagged a little bit. It was about at 29.2, 29.3%. It's a little bit less than Ernie, but still beating the SPY. But yes, there are investors that do that. It's not wholly recommended, but it is something that can be done as well. William. All right, so let's go into William's questions. William's questions, and then we'll get to Patrick's questions as well. And Thomas says, thanks, you're welcome. And Javier says, thanks, you're welcome, Javier, as well. All right, my apologies. William, do you think the Married Put by itself is better than long SPY put leaps to hedge the whole portfolio? My answer is yes. Now, the reason why, and I'm going to pause for a moment. I'm going to navigate over to YouTube. We're going to go to our YouTube channel real quick. And here's some of the recent videos, Tale of Two Stocks that we discussed, the Married Put versus other strategies, and low maintenance trading. That's the one I talked about. We're going to have part 2 coming out in the next couple days. But on Power Options YouTube channel, I'm going to do a search, William, for stock or portfolio. I'm just going to go stock or port. Okay. All right. Now. Okay, let's do that a little bit better. Stock or portfolio. Let me get my arm off of that. There we go. Sorry. Portfolio insurance. So we have done videos in the past on this and recently as well. Don't want the semicolon in there. My apologies, sir. All right, there we go. So stock or portfolio insurance. Let's see if I get the results that I'm looking for. All right, there we go. These are older, 7 years ago, but some of them are 4 years ago. Stock or portfolio insurance. Part 1, Part 2. Do I think the Married Put by itself is a better hedge? Yes. And there's some discussions that we talked about in here. We had a gentleman years and years and years ago, more than 8 or 9 years ago, who, it might have been in 2008, 2009, when it might have been after that, but he had a very large portion of GE in his portfolio. And he had other positions in his portfolios, but the GE position was probably 60% of his stock portfolio positions and options trading. It was probably 60% of his portfolio. I think he worked there before, got stock options, owned stock, and so forth. Well, during the time period, he also had puts on SPY. Over the course of the next 6 months, GE dropped from whatever it was, 36, maybe 38, down to 18. SPY at the same time was up 9%. We've seen multiple occurrences of this during the different years where the market is hesitant or just down slightly, but some of the big stocks in your portfolio, they're like, oh, there's not going to drop. Tesla, NVIDIA, it's gone through ups and downs. Apple, not really, but it's had some ups and downs. But as that falls, naturally, I'm sorry, if you were in those 4, Tesla, NVIDIA, or Apple, you would have been in QQQ puts. So that would have hedged it. But you would have been better off keeping the risk to single digits. It's more expensive, William, absolutely. But at the same time, if you have 1 or 2 stocks in your portfolio, whether they're an SPY based, whether they're Russell based, or whether they're NASDAQ based, the underlying SPY, S&P 500, the NASDAQ, and Russell is generally stagnant or moving up, but your stock's down 15 to 20%. That SPY hedge, that QQQ put hedge, that Russell 2000 hedge is not helping you. It's losing money as your stock that's a bigger portion is losing money. Is it maybe more cost effective? Yes, I get that. Are there other options that are available? Absolutely. Trading the volatility. VIX calls for portfolio insurance in an expectation, of a sudden move. You get more bang for the buck with the VIX. But it also comes with a caveat that we have here. We discuss other things. If you look up VIX here, VIX calls, things of that nature. Usually when you see the VIX spike, you got to close about half to 3/4 of those VIX calls there to cash out quickly because it usually reverses. It might come back later, but you're usually buying calls on the VIX that are only 40, 35 days out in time, depending as well. But you take a look at the stock or portfolio insurance part 1, part 2, the UVXY or VIX. There's another one. Oh, there's the perfect one 2 years ago. My apologies. This one, check it out. Use that term, hedging stocks directly. Just write in hedging stocks directly, and it's going to give you a basis. There's another one here. I was hoping that would show up. It didn't. But here's another great one we did a few years ago. I'm just going to look up market hedge instead. Okay. So the one I'm looking for is a gentleman that said, could I use a bear put debit spread for lower cost on SPY to hedge my portfolio? And yeah, we went ahead and take a look. Hedging a short, no, that's not it. There's the hedging directly. There it is. Bear put debit as a market hedge. So we compared looking at VIX calls, puts on SPY, insuring the stock directly, or using an SPY bear put debit, or SPX, bear put debit as a hedge on the position. In this case, actually, the bear put debit spread worked out the best because the underlying markets only fell 4 or 5%. But then we showed if it continued to drop down and it fell 7 or 8%, you would have been better off with one of the other hedges as opposed to the limited, even though it was a lower cost. Hey, we want to save money on insurance. Let's use a bear put debit, which has a hedged gain. It has a hedged fix. In that case, Thomas, I'm sorry. But that's another good one to view. Ways to hedge a stock position from last year. Good concepts there as well. So maybe market hedge is the one you want to use. hedging stocks directly versus portfolio hedge. More information on that, our thoughts, best index to hedge a portfolio plus time decay of an option, bear put as a market hedge, and ways to hedge a stock position. Full look there on that, and you can take a look there. But yes, in my opinion, it's better to secure it one-to-one, more expensive, but at the same time, sometimes you'll see that as well. All right. Oh, okay, Thomas. So you say how many married puts does your average client have at any given time? It depends on the account size, but usually it's only about 7 or 8. And the reason why is because the rules in the blueprint, that second layer of protection. So I'm looking here. Let me look at the good. I mentioned Fiverr, so I'll just take Fiverr. 3180, the 34 put for around 505 mid price, risk of about 7%. So give you a little bit of insight, a little bit of extra kick in the blueprint that's available for those of you that don't own it. Well, yeah, I'm going to buy a position that has single-digit risk to stack the market odds in my favor. What else am I going to do? I'm going to make sure that the monetary risk on my position does not represent more than maybe 1.5% to 2% of my total portfolio. So let's say I'm trading with a $50,000 account, or I'm allocating, let me say I'm allocating, $50,000 to the Married Put portion of my portfolio. Well, that means with a 2% risk on any one trade, I can only risk $1,000, right? So 285, what does that dictate? I can do 400 shares and 4 puts. Now, what is that going to do? That's going to put this up to about $13,000. All right, that represents a fair chunk of the $50,000 total I have. But the risk on that 4, it's going to be a little bit above 1,000 at 400 shares, right? It's just going to be just above. Let's go ahead and plug that in. So I might do 3, but let's do 4 and 4. It's going to be what is 1120? I'm sorry, 1140. Is that 1,140? Yeah, 1,140. I'm sorry. So a little bit above. So let me scale that back down. Let's go 3 and 3. So this is the sizing. You've heard me say the 3 core principles of forcing an ideal size trade. It's not just about controlling risk, but what dictates how many shares and puts am I going to buy in a position? Well, here it is. $50,000 account. Going to risk about 2% in any one position. The monetary amount, yes, I'm investing close to 20%, a little bit over 20%, my apologies, of that $50,000. But the monetary risk is under 2%. So even if this position hit the maximum risk, which we wouldn't let happen, we're going to sell some income methods. Fiverr pays a dividend. I'm going to collect some of that at some point. It's not going to be the full 7.7, but 855, less than 2% of that total $50,000. I've retained that. That's the second layer of protection. Stacking the market odds in your favor, forcing an ideal size trade. That's the extra step. So right away, you see $50,000. I put $11,000 in this trade. I open the next trade at rally, with a max risk of 214. There's 400 shares. Total investment of 27. So now I'm at about at $93,000, $96,000. I'm sorry, $93,000, $9,600 with 400 shares here, right? Maybe a little bit up, another $10,000, close to it. All right, so now I've got 2 positions that now represents 40 to 42% of my total portfolio. So in general, that's why I'm only going to have 5, 6, or 7 positions open, married puts, because I'm controlling the risk. The monetary risk on the position helping me dictate how many shares and contracts I buy in this case. And that's why I might only have that amount open. Yes, I have some married put investors who say, well, I have $50,000. I'm just going to put in $5,000 into each married put. I'm going to have 10 trades open. Okay, we are only going to be able to do Fiverr, Remalty, Clivu, and maybe 1 or 2. You're not going to get to 10. All right, you might only get to 8 or 9 based on the ones that are here, but we never do that. Anyway, another part in the blueprint, our suggestion is when you're opening a Married Put portfolio, I'm going to open 1 or 2. If I'm starting brand new in 2025, we're going to have a video for this for new blueprint owners and blueprint owners. If I'm starting a new Married Put portfolio, let's say that $50,000, I might have opened 1 or 2 positions last week. And then maybe I'm going to open a position next week. Then I'm going to wait another week or two and open another position. I know I'm going to have only 5, 6, or 7 positions open, but I'm going to stagger it. Why? Because even in that short time frame, news is coming out. We saw the jobs report come out today hotter than expected. That led the market to believe that the potential for a rate cut soon is going to be much lower. We've got the inflation report next week. In 10 days, we've got the inauguration, and probably 3 to 4 days after that, we're going to see some initial executive orders that are put out related to the economy and related to other aspects for the new administration. So sectors are going to change. Money is going to change. So I'm going to stagger my long-term Married Puts. These aren't in the money covered calls. These aren't my out of the money bull put credit spreads that I'm doing 1 or 2 weeks out in time where I'm going for that protection like Javier has. You know, I'm fine with that one. I've got good protection in it. That's what I'm using. I'm looking to make a small return. Even if the stock goes up 10, 15, 20%, looking to make that 2.2% return with 17% downside protection. Hey, that looks good. Can't fault it. I'll miss the other upside, but that's my target goal. We'll take it. But things are going to change. Longer term outlooks are going to change. Positions I opened, let's say this last week for a Married Put, a month from now, my sentiment might change based on those changes we're going to see in the next 3 to 4 weeks. Stock's down 10%. What am I going to do? I've been in a Married Put that had 8 months to expiration. I've been in it for a month and a half. Stock's down 8%. I'm probably only at a 2% loss. My sentiment has changed. I'm no longer bullish on that sector or that stock based on new policies, new economic factors, new inflation numbers. All right, let me liquidate it. Take a 2% loss on that trade, which is probably less than 0.3% of my total portfolio, with forcing the ideal size trade to begin with, where the max risk was only 2% of my total portfolio. With the position down 2%, that's only 0.3% of the total portfolio that I just gave up. And I'm going to look for new positions that now match my strong sentiment going forward.